Bismillahir Rahmanir Rahim. Good morning, everybody. We'd like to welcome all the shareholders and the analysts and different stakeholders for their time and interest. I would like to introduce ourselves. My name is Abdul Wahid Al-Murshidi. I'm the CEO of Sohar International Bank, and I have my colleague Majid Al-Bousaidi, the Chief Risk Officer, and Fahad Zidyali, the Chief Islamic Banking Officer, and our colleague Azzan Jahwari, the Chief Economist. We'd like to thank all the stakeholders, from the regulators, shareholders, employees, and mostly the customer, for their support in our mission and to achieve those results in 2025. While we are witnessing a dramatic change in the geopolitical power and balances which affect the global economy in a way which we didn't witness before, we believe that we are in Sohar International we are confident that our operations, balance sheet are stable, and our vision and mission will be on the right track. If you allow me, we can start the presentation with Oman Economic Overview, which will be presented by Azzan Jahwari.
Thank you. Oman's GDP stands at 40.5 billion OMR in current prices, with real GDP growth of 2.9% and inflation at 0.9%, the second lowest in the GCC and ninth globally. The global environment has not been without its pressures. Regional geopolitical dynamics have introduced a degree of uncertainty into energy markets and trade flows, and the situation remains fluid, with visible effects on commodity prices, supply chains, and investor sentiments throughout the region. These are conditions no economy outside the Gulf operates outside of completely in the Gulf region. Oman, however, has maintained stable fundamentals throughout. The stability is the product of the reform agenda anchored in Vision 2040, Oman's long-term national blueprint for a diversified and sustainable economy, and one that has been consistently applied throughout the years. The reform is visible in the sovereign credit profile. All three major rating agencies, Fitch, Moody's, and S&P, currently hold Oman as investment grade with a stable outlook. Debt to GDP has declined from 67.9% to 35.7% in 2025, and overall fiscal balance now stands at a positive 0.4% of GDP. The consolidation work of recent years is reflected in those numbers. The improved sovereign standing has translated directly into investor confidence. FDI net inflows are running at 11.6% of GDP against the world average of 1.3%. Oman has become increasingly compelling as a destination for international capital, and that is reflected in the market. The MSX 30 index has closed 2025 up 28.2% year on year, a performance consistent with an economy that continues to attract and retain investor interest. Moving on to GDP composition. Petroleum activities account for 33.6% of GDP, while the non-hydrocarbon economy already accounts for a majority of output. And broadening that base further is precisely what the 2026 budget is trying to do. Revenues are projected at 11.4 billion, up 2.4%, with an expenditure of 12 billion OMR, up 1.5%, producing a projected deficit of 0.5 billion against the planning oil price of $60 per barrel. Within that revenue figure, net oil contributes 50%, non-hydrocarbon 33%, and gas 17%. A composition that continues to shift in favor of the non-oil economy. Nevertheless, there still remains volatility due to the stated geopolitical uncertainty. The 11th five-year plan, covering 2026 to 2030, is the current operational framework through which Vision 2040 is being delivered. Its three strategic sectors, the digital economy, manufacturing, and tourism, are backed by committed capital. The 2026 investment allocations reflect this directly. 4.5 billion in government allocations, 1.7 billion through OIA, 1.3 billion through development, and 1.5 through energy development Oman. Sohar's international strategy is aligned with those same pillars and sectors. As Oman continues to diversify and develop, our role is to be a financial partner to that growth. Thank you.
Thank you, Adnan. So Sohar International, being the youngest commercial bank in Oman, with a total asset of around $24 billion as on 31st December 2025. We completed the merger with HSBC operation in Oman in 2023. We have almost 1,700 employees, 560,000 customers, 78 branches between conventional and Islamic, in addition to one branch in Saudi, and we are looking to open a rep office right now in Hong Kong. We are the fast growing bank and the second largest bank in Oman. We are on the top 5 market capitalization on MSX. We have stable Fitch ratings and Moody's, which was appreciated by everybody. Our operation distributed between wholesale banking, which represents 66%, and retail 15%. Our Islamic operation is 11%. Out of it, almost 70% of the 11% is in wholesale, and we have KSA branch, which represent 8% of our total asset. Next. So, with a market cap of 3.9 billion US dollar and authorized capital of 1 billion Omani Riyal, our share prices grow almost by 112% since the merger with HSBC operation. Our major shareholders are the Royal Court Affairs, DIDIC, and different institutions like the Seventh Moon and Neptune Investment. And the balance 50% is owned by different institutions. Next. For the financial performance, I will leave it to our colleague Greg, who's will represent it online. Unfortunately, he's in his annual leave. However, he will present it. Greg, please.
Excellent. Thank you, everyone. Can you hear me?
Yeah, it is very clear.
Excellent. Thank you very much. Good morning, ladies and gentlemen. Thank you very much for the introduction, Jawad, and for the economic overview, which is obviously very relevant to setting the platform and discussions going forward on the bank's performance. Maybe if I could just take a moment to reflect on page 7, the performance of the bank, noting that the HSBC merger occurred at the end of 2023, and therefore when we're looking at balance sheet, that represents the consolidated balance sheet when we're talking about profit and loss, and comparing 23, 24, 25. 2024 was the first full year recognition of the merger activities. What's important to note too is that if you look at the compound annual growth rates, the HSBC merger generated 1.1 billion of loans, 1.7 billion of deposits, which significantly supported the bank's liquidity, and assets of 2.3 billion. It's important to note too that the continued underlying organic growth of the bank generated additional 700 million of liabilities post the merger period, in reflection of the stronger liquidity and ability of the bank to source funds. I'll move to page 9, please. The profit for the year of 100 million was in line with last year's performance. However, the dynamics of the results are different. I'll reflect firstly on the net interest income and the net interest income and the net profit income from Islamic, which is down 13.6 million. There are two drivers here. Clearly, with the increased balance sheet, we saw a positive impact, volume growth, noting our loans are up 35%. But we did see a negative impact on the rate variances, i.e. interest rate driven. The bank's cost of funds overall was slightly up. However, the story in our numbers was around the yield, which was significantly down overall due to the bank's US dollar position, particularly around treasury bills of around 1.5 billion, and as you're aware, rates sold off by about 125 basis points. That was the major driver of the reduction in the bank's yields. Noting also the bank has the lowest loan deposit ratio in the market, which provided us with the surplus liquidity again post-merger. If we look at the other operating income, the increase of 21.1 million, there are four key components I wish to share. The first, as reflected in our financial statements, was a one-off gain on the sale of Oman International Sovereign Bonds of 5.8 million and dividend income of 2 million. The balance of 13 million can be looked at in two component parts. The first is the successful story we had in terms of the growth of our asset management, global banking and market business, generating fee income across the investment banking, treasury and advisory services. The remainder of the other operating income performance was in correlation with the increase in the size of the balance sheet through loan processing, commitment fees, etc. If we move to the total operating expense base, the increase of 13.1 million is reflected with an increase in our staff costs of 3.2 million. There is an underlying increase in our headcount of 10%, which is supported by the recruitment of young and minded talent, creating a future platform to learn and develop within the Sohar international entities. If we look at the balance of the other operating expenses, increase of 10 million, I'll refer to three component parts in general terms. The first is IT related. The bank continues to invest in IT platforms. We saw increases in AMCs, annual maintenance contracts, license fees and communications. Another third of that increase I'd describe as discretionary spending, where the bank has invested in marketing, sponsorships and developing our international business. And the third I refer to as transactional in nature, which includes such costs as credit cards, withholding tax, VAT, all related to the significant increase in the bank's volumes. Functionally, if we were to consider the 13.1 million increase, 3.6 million relates to our continued investment in our branch in the Kingdom of Saudi Arabia, 2 million in relation to the expansion of our Islamic business, 5 million in relation to retail, and 2.5 million wholesale. If we move to the gain on bargain purchase, this is a one-off event and it represents additional gains in relation to the HSBC merger, noting that the bank had earlier reported in 2023 92 million, and this is the balance of 9.2 the bank has recognised. This is a one-off event, and it's reported extensively in note 40 of our annual financial statements. The loan impairment charges for the year were better by 11.6 million, resulting in a cost of risk of 48 basis points, noting the market median for 25 was around 60 basis points. The tax benefit we see there is a one-off event. 3.5 million includes post-tax, prior year post-tax return benefits, as well as a deferred tax benefit we've realised on a life-to-date basis for the Kingdom of Saudi Arabia. If I then move on to page 10, the 2024 result is the first year of post-merger P&L. The ROE has declined due to a flat profit and an underlying 130 million increase in our share capital that occurred at the end of 2024. The net interest margin for the bank has reduced to 2.0%, and I've explained the main driver for the underlying yields. Noting, as I mentioned, the cost of funds remains fairly flat, although there are dynamics underlying the cost of funds as well as yields. Other operating income I've discussed, and the resulting cost-income ratio has increased to 44.2%. We move to next page, please. If we consider the bank's balance sheet, we have a reasonably simple story in terms of the mix. Our 1.5 billion increase in loans was significantly contributed to by our growth in Kingdom of Saudi Arabia, $500 million. Retail was 150 million, our Islamic was 100 million, and and corporate was the balance of 850 million. In terms of funding, this was funded again through 1.1 billion of customer deposits and 400 million of interbank. Kingdom of Saudi Arabia matched its increase in assets, raising 500 million. Islamic exceeded its loan growth and was able to fund 200 million, and our corporate book increased by 400. The perpetual bond, which the bank generated in Q4 25 of 200 million, supported the bank's capital position as well as its liquidity, particularly coming into year-end. The significant increase in the interbank balance was really due to the year-end positioning for the bank to support our liquidity positions and funding and loans to our corporates in December in particular. Page 12. The bank has very strong capital ratios. Our common equity tier 1 ratio of 13.5% into December compares with the market median of 12.1. Our 16.7% tier 1 ratio compares to a market median of 17.7, and our total capital ratio of 17.3 compares to a market median of 18.6. The bank continues to have very strong shareholder support in terms of the bank's capital raising in the event we wish to move forward with faster or accelerated balance sheet growth. Page 13, our funding and liquidity remains strong. Our CASA ratio of 65 compares with market median of 51. Our loan deposit ratio is well below the market, 84%, market median of around 103. Net stable funding ratio of 115 is above market median of 130. And our LCR this year at 186% compared to a market median of 158. On page 14, the bank has seen an increase in its NPLs in 2025 of 64 million. And you'll note that our coverage ratio has dropped. And that's really as the bank has looked at its effective management overlay that it has available, and looked also therefore at the levels of ECL that we need to book and support our IFRS 9 modelling. Our sector concentrations are reducing over time, noting our construction sector was at a lot higher levels than what we see here today, and the bank continues to diversify across its sectors. That's all I have at this stage on the financial results, and we look forward to your questions.
Thank you, Craig.
Thank you.
Thank you. So, thank you all of you for listening to our presentation, and we'll be glad to receive your questions and inquiries. I think that's a question, correct? Greg, there's a question which we'll send it to you. It's about our strong loan growth while declining the margin. Maybe you can provide the details for that, which you did, I think, in the presentation.
Yes, sorry, I can't actually see the question.
We will send it to you right now. For the second point about the 2026 and 2027, I think we don't provide any forecast for the analyst. So that's I answer it, but the details of the decline in margin and growth in loans, Greg will provide it to you. Greg, the question is, yeah.
Yeah, I'm sorry, I can't.
The question is why there is a decline in the margin while there is a strong growth in loans. Just to answer it, I think Greg, he answered it. I think we have around 1.3 billion Omani Riyal in treasury bills, which used to earn north of 5% in 2024, and in 2025 the rate, or the average rate of those TB declined to around 4% or below 4%. We believe that we need to keep adequate liquidity. We are one of the most liquid bank in the region, and that's proof our vision in this difficult time. So in such difficult times, you need liquidity to ensure you continue your growth, and that's what we are doing.
Adding to that, I think it is worth also noting that the growth that you have referred to in your note in relation to the loan book of 20% year on year has actually materialized in the second half of the year between Q3 and Q4. So we are yet to see the total impact of that, which is expected to be a lot more visible in 2026 than 2025.
Yes, I've just, sorry, thank you, Jim. I've just seen the question. Look, there are two sides of this. Firstly, volume, the increase in the volume of our loan portfolio. We look at our AROC returns on the additional lending that the bank is doing to generate fee income, and that will therefore enhance the bank over return. In terms of margins, we do see increasing pressures on the bank's cost of funds. And we are actively looking to reprice our liabilities in line with the market. Conversely, we're also looking to support the growth initiatives in Oman as well as KSA, and therefore we're having to ensure that we have sufficient funding, and we do need to compete at the market for the funding. Likewise, on the asset side, we have seen a drop in the yields on the treasuries. That appears to have plateaued, which is therefore supporting our position. And where we have the opportunity to reprice assets, we're also looking to do so. Conscious also of the environment in which we're operating, where we still have a number of our corporates who, are still under stress from COVID.
Yep. I think the other question is about comparing to other banks. Our investment grow by 1.6%, while the other banks' investment books grow above 30%. I think we explained that we'll continue our investment on loans, or to grow our loan books mainly, which support the Oman Vision 2040. The investment mainly, there's two parts, either investment in the prop book, which include the equity portion. I think we are doing well there, and that was clear on the other comprehensive income. While the investment in treasury bills, that's a liquidity tools, which we will manage it based on the forecast of the interest rate and our liquidity positions.
Yes, completely. May I also add, Dr. Wad, that in relation to forward-looking numbers, please be advised that our Q1 results will be announced shortly on the 15th, and the Q1 detailed financial statements will be published by the end of April.
The second question about what would be the normalized loan growth for the bank going ahead. Of course, we don't provide a forecast. However, we are part of the economy, and we are part of the Oman Vision 2040. And there is so many opportunity in the economy where we can lend, which support that vision. And we will be very selective on those opportunities and selecting the bankable opportunities. The other question, 2025, you issued OMR 200 million virtual security, while the interest paid in the previous 80 securities, sorry, it is not clear. 3.7 million in 2024. And
They're referring to the coupon.
yeah, they are referring to the coupon rate of.
Yes, I mean, what you'll be seeing there is the timing of the payments on the interest.
Yeah.
The bank fully repaid its previous Tier 1 instrument. So in prior year, you would have only seen one coupon payment. And the current 200 million, we've just had one coupon payment just recently. So it's really about the timing of the coupon payments. And of course the volume, which is about 100 million versus 200 million that we now have issued. And repaid the original 100.
The second question, when the KSA branch will reach the return on equity similar to the Omani operation, we don't provide any forecast for that, but I think that will be soon. I mean, I can say within 3 years or less. Magid, the last question about the cost of credit. I'll leave it to you.
So this is again a question that requires or seeking forward-looking view that we do not provide here. Nonetheless, what you could probably refer to is the trend that we have been maintaining over the past years since 2020, not just since 2024. The total amount of resilience built is in excess of $1 billion that provides adequate coverage over our stressed exposures, currently standing at 134%, post the classification of around 63 million riyals in 2025 alone. So what you can reasonably expect is the same amount of prudence applied consistently. That's a general question.
Yeah, sure. We will note that in the future about having the conference call after the quarterly result. We'll note that in the future. I assume there is no more question, and we'd like to thank all the investors, the analysts, for their questions, their participations, and their interest. And our doors always will be open to welcome any queries or any questions which we can help in the future. Thank you, and looking to see you soon.